Welcome back, investors. So today we're going to be talking about stock market crashes and why you shouldn't fear them and actually you should embrace them, because this is a time when people and investors get rich. Now, if you look at my portfolio, it has been very rocky. So there was a recent sell-off. So at the height of this month or even last week, I was at 12.84%. And as of yesterday, major sell-offs on all industries and all markets in pretty much all geographies went down to as low as 3.36%. Now there's been a mini bounce back to 5%, but I want to showcase why these kind of dips shouldn't be concerns for you. And in fact, you should try, if you can, put more money into the market for companies that you believe in, that have strong fundamentals. And I want to show you why. So if you look at historic stock market crashes, they have always pretty much recovered. So this is the graph for the S&P 500 for the last 100 or so years. Now, as you can see, there's been several times when they've come down, and I'm going to talk about them, but they've always recovered. So if you start from here, it was 354, and now today, even though there's been a crash, it's at 5,045. So look at that trajectory from here all the way here. It's pretty much all the way up. Now, so what have been the major stock market crashes that we should, and I'm pretty sure people panicked then, but let's look at them. So the first one here, this is a 1929 Wall Street crash, which resulted in a 21% decline in markets, going down all the way down here. But as you can see, the markets eventually recovered. Now, the second one I want to talk about is in 1937, essentially the Great Depression. Again, markets collapsed, and this includes World War II, and they kept coming up. The next major financial crash was in 1987. This was the Wall Street crash, where the markets declined again another 20%, and people were obviously very fearful. But if you bought here, look at how much you would have gained in the next 5 or 6 years. And this is what I am, a long-term investor. So for me, these kind of things aren't something I worry about, because I am looking at 5, 10, 15, maybe even 20 years of horizon. And in the long term, these companies will go up. The next one was the 2000 dot-com bubble. This is when there was rapid growth in valuation of companies adopting the internet in some way to make money, which was fueled by low interest rates and available venture capital. Pretty much any company that was launching a business online got a lot of money. A lot of these companies failed to become profitable and burned through their cash reserves, resulting in a lot of them going bust, which eventually led to the dot-com bubble bursting, essentially. Now, look, the market went down a lot. But then if you bought here or even here, within a few years, you were already making a profit. Now, the next one was the 2008 global financial crisis. This occurred when the US housing market collapsed after realization that many people were given mortgages which they couldn't afford, as lenders had loose lending criteria at the time with little or no financial means testing. These were then hidden into other products to cover up the bad debt. And this was documented in a very good film starring Christian Bale called The Big Short. If you haven't watched that, I would highly recommend watching it. It was pretty good. And then it all came crashing down when people defaulted on their mortgages in large numbers, which led to major companies collapsing, housing and mortgage companies collapsing, including the investment bank Lehman Brothers, which was a major powerhouse in the investment banking and mortgage lending world, and that collapsed. So that was a big economic downturn, but again, the market recovered. And then we go to the most recent one, which is one you would be most familiar with, I guess, is the COVID-19 coronavirus crash, the pandemic essentially. And this is where I feel was one of the biggest ones in terms of in all of these historic events, companies weren't forced to shut down. And in this instance, many companies were simply forced to shut down because people couldn't go out and spend, or people couldn't leave their houses. And again, if you look from there, the market has recovered again. So I hope these are all examples that, you know, these are opportunities to continue investing in the market and do really, really well. Obviously, if you were alive at any of these times and then you invested, look, all the time, eventually, sometimes it takes a bit longer than other times, but the market has gone up. So please don't be fearful. If you look back at my portfolio, for example, I have bought another part of the dip there, I bought another part of the dip there, and today I loaded up another £1,000 and put it into my pie, and I believe this is gonna prove very fruitful going forward. In about a year's time, when you see the share price of these companies, I think they're gonna do very, very well. So just a quick, you know, just don't panic, guys. I mean, these kind of things happen. In fact, we should embrace them, because this is the time when we're gonna get good companies at discounts, and you should be going out and buying them, which I did. If you found this video useful, please give it a like and subscribe to my content, and hopefully other people see it, and hopefully other people don't panic either and actually take advantage of this dip and buy more. So thank you very much. See you in the next video.